In this episode, we take a look at the 7 pillars to grow your wealth.
Welcome to Click AI Radio, where you'll learn the secrets to transforming your small to medium business. Grant has been helping businesses transform using technology for over 30 years. Advanced technologies like artificial intelligence have been available only to large companies and advanced technical teams. Grant will discuss how you can use to leverage AI and other technologies to grow your small to medium business. As a gift, Grant is offering his ebook, AI for Sales Growth, at clickairadio.com. Now, here's your host and biz tech geek, Grant Larsen.
Hey everybody, welcome to another episode of Financial Investing Radio. My name is Grant Larsen, and today I have in the house one of those unique people that understands some of the fascinating ways to build and protect your wealth. I'm excited to have with me here today, Seth Hicks. Welcome, Seth.
Thank you so much, Grant. Glad to be here.
So when you reached out to me and you started to say, hey, could we talk? I started to look into what it was you were doing. I'm hearing words like private banking and asset protection expert. And you hear some of that stuff and you think, oh, wow, do I have to have an advanced degree, right, in financial management to understand this stuff? But what occurred to me is that I've seen some of these principles before. They don't seem to be well known by most. And so what I'm excited about is the opportunity through this channel here for you to continue to get your voice out there and say, here's the way that you can build and protect yourself. So first of all, how did you get into this?
Well, I practiced law for about 25 years now and have structured transactions, commercial real estate transactions, business acquisitions and sales, and kind of help people keep what they make, so to speak. And when I met my now partner, Vance Lowe, the principal of private banking strategies, it floored me to find how easy it was to make a few changes and effectively do 100% better job. And so what I mean by that is at private banking strategies, we use whole life insurance policies that are structured in a way to have a high cash value. And in the appropriate structure and appropriate jurisdiction, they're statutorily exempted and protected, much like a homestead in certain states and many of the same states. So, for example, Grant, in southern states, you've got a post-Civil War era legislation where
it goes that far back, post-Civil War. Okay, all right,
absolutely, yeah. So private banking goes back as far as Civil War era, and even before that, it precedes branch banking. It precedes the type of current culture banking that we have, and the post-Civil War era statutes protected their citizens, the state citizens, from northern carpetbagging. So for example, for like example in Texas and Oklahoma and Florida and a lot of those states south of the Mason-Dixon line, you have laws that protect homesteads. So in the event that there's a liability and someone has a homestead that they've declared, it is 100% protected from being taken from them. And that was a product of the Civil War.
So let me ask you this: when you talk about protection from having it taken, I'm assuming you're talking about scenarios like maybe bankruptcy scenario or something else where you owe other people, but you've got this protective layer that no one could actually come in and take that foundation from you. Is that right?
That's right. A lot of our clients, higher net worth. Some are ultra high net worth. Many are blue collar, but they have created strategies to keep what they make. I mean, no one wants to effectively work hard to earn money and then lose it. So those type of folks who gravitate towards structures where they're able to keep what they make. So, for example, if you've got a homestead in Texas or in Florida, and you want to use it as a vault, and you don't have any debt on it, and you're able to pay the property taxes year after year, then it is 100% exempted from creditors or from outside taking, so to speak.
So that's an important baseline, is that it does need to be debt free. You have to have no mortgage on that or any liens against that. Would that be right?
Sure. Yeah. If you've got a loan with a traditional bank, they have a right to the mortgage payments, and so they will effectively, if not paid, foreclose on that, and those rights are obviously superior. But if you're in a position where you're able to, for example, use your own private bank through the cash value in your own policies, and purchase and acquire your home or other assets through that entity, you would do the same structure. I mean, obviously, your bank, and part of the cycle is getting the money back. And that's something that Vance prides himself on, is teaching people how to get the money back. You've probably heard some of that in your private banking. That's one of the reasons that people do it. They effectively take the banking equation back into their own lives.
Back into their
own.
own.
They become the bank.
So right. Is the flow something like this? You get one of these whole life policies. It takes some time for you to build up some cash value, but then that cash value becomes something you can leverage and use for either purchasing other assets or leveraging it in other investments, so to speak. And that has some protection wrapped around it. Is that what you're describing?
That's exactly what I'm describing. And like I said, a lot of our clients are higher net worth, or even ultra high net worth. And when they capitalize their bank, they are able to do a lot more with it right out of the gate. But for the blue collar guy, you're right. It's a steady increase that you use. A lot of folks use this as a retirement strategy, because the ins and outs are not a taxable event. And if any of the audience wants to dig on that, it's Internal Revenue Code 7702. And what that basically outlines is that your whole life policies, your cash in and your cash out, are not taxable events. So compare that with like an IRA or a 401k that someone's been socking money into. When you take those distributions, well, if you take them too soon, you're penalized.
You're penalized.
If you take them too late, you're penalized.
Yeah.
But if you take them right in the right time, you're still paying taxes on it.
You're still paying taxes on it. So every single cash transaction on the cash value, no taxation on that.
Correct.
Right? That's amazing. How does a blue collar person or someone that's not ultra, how do they get started then? Is it, I hate to say as simple as, but is it as simple as getting started with your whole life policy earlier in your life than later, so you can begin building out that cash value? Is that the number one thing, or what else would you do?
I wouldn't say age is the number one determinative factor. In fact, we've got an article and a podcast that we produced that says, you're never too old to start private banking, and here's why. And we go through the outlines, the benefits and values, which include asset protection, tax-free growth, financial privacy, no taxation on the legacy value. So if you're leaving a high value to heirs and beneficiaries, you don't pay any taxes on that transaction, even if it's a ultra high. Yes. So there's some value there depending on what your primary motivations and focus are. And the age, of course, if you start earlier, you're going to accrue a much greater and higher value as you go year after year. Right. But let me give you an example. We've got one of our favorite clients is a woman in Texas who was a single mom, and she started out with a $5,000 annual whole life policy. And she made that contribution for a few years, and then used that cash value to as a down payment into an investment property.
Oh, really? Okay. Wow.
So she purchased this investment property and then she also had third-party financing, of course. And she began to develop cash flow from that, and she paid her private bank back And as that cash value increased and increased, she did the exact same thing. She rinsed and repeated the process with the second investment property. And now she has a $1 million equity portfolio in real estate.
Wow.
From where she started at $5,000 leverage. Now we've been, she's had the benefit of an appreciating real estate market. She's had good investments, but it illustrates the principle that you can actually start in that small of an amount and multiply that seed into something that really brings a large harvest.
That's fascinating. One of the things I noticed from you was, I think you called it the 7 pillars of private banking strategies. Can you speak to that for a moment? What are those?
Sure. The first pillar we've been talking about is asset protection. And the second pillar is tax-free growth, which is, we also reference that, compare that to a 401k or an IRA. You may have tax-free growth inside, but you're going to pay taxes when it comes out. And we've got some illustrations that kind of compare those two things and show you, which comes out ahead. And it may look like a contributions from an employer and other matching proceeds will come out ahead, but over time they really don't. So inside the policy, you've got compounding growth, and you've got a tax-free growth, and you've got a financial privacy. Third pillar is financial privacy. Whereas compare that to a bank, for example, who has to KYC, know your customer. They want to understand, every aspect of money in and money out. You go and try to take out or put in a large cash sum, for example, a $5,000, $10,000 cash sum into your Wells Fargo or Bank of America account, and they want to, cross-examine you on 50 questions about why you're using cash, where that doesn't happen in a private contract with the life insurance companies that we use. It's totally private, and they don't raise their hand and go, hey, there's a large transaction in or out, and they're not required to by the IRC 7702.
Then they're not really staffed for that either, right? I mean, it's just not part of their business model, right?
It's not part of their business model, no. And and it's interesting to point out, this is kind of a little sidebar, but the largest players or the largest clients of the life insurance companies are the centralized banks like Wells Fargo and Bank of America. I think the last time I looked at Wells Fargo has a $20+ billion annual premium for life insurance policies that they hold on employees and others. So if, it gives you some insight.
That's huge. Okay.
So
asset protection, tax-free growth,
financial privacy. A big one is velocity of money. And
so what's velocity of money?
We described that a little bit in the example that I gave our audience with the woman who started with a $5,000 premium. And then when she had enough to make a down payment on an investment property, she did so. And so she paid a premium dollar into the whole life policy. She borrowed that same dollar out to make a down payment. She purchased a piece of real estate with that dollar. She got a rental dollar back from the tenant, and she paid her bank back on the note and deed of trust. And that's the velocity of money. It's the multiple touches within your own economy of the same dollar. And I mean, I'm simplifying it there with $1, but that's effectively the transaction.
Now that, like you said earlier, it's the rinse and repeat principle, right? Meaning,
absolutely,
she's put it out, she's liquidated it, used it, acquired some capital back, repaid herself, and now she's reset to do again, right? That's
absolutely.
That's amazing.
And every dollar that she pays back into her bank, Grant, it increases the cash value dollar for dollar. So you've got that loan from your bank coming out, and when you recycle that rental cash flow back in, or that business cash flow, or that cryptocurrency sell, or whatever your investment might be, back into your bank, your cash value goes right back up to whatever you've put in it. And And so you and I both know that banks, they make money by lending money.
Mhm.
So Wells Fargo and Bank of America and Chase and these large centralized banks, they put their money to work by making good loans.
Yeah.
They make loans that are secured. They make loans that are collateralized, and they ultimately they want that cash flow with an interest rate. Well,
Right.
it's the same principle with your own private bank, and you want to make a good loan to the borrower, whether it's your business, whether it's your brother, whether it's whatever, a third party. You want to make a good loan, make sure it's collateralized and secured, and that you've got an investment cash flow and an ROI on that loan coming back to your bank. And as that cash flow increases again, you do the same thing. So you begin to think like a banker.
Yeah, you think like a banker. Yeah.
Yeah. You think
Which
like
is
a
awesome
banker.
because that's so liberating, right? To people to be able to be on that side of the table, right?
Absolutely.
Making those choices. All right. And then what's the fifth? So there were seven. So that was four. What's the fifth one?
Well, are you looking at the
Yeah, I'm
outline
looking
of
at your seven pillars. So, yeah, there were seven that you'd put in there. So you got
guaranteed financing? Guaranteed
yeah.
financing. So let's say that you've done like our hypo example with the woman there, and she's gone through a number of years. She only started with 5,000, remember?
Yeah.
But now let's say that she's got 100,000 in total cash value, and she's in a state like Texas where you can buy an investment property for 100,000, or she could lever into multiple properties on like an 80-20 split, for example. She could buy 5 properties with 20% down and put 20,000 down on 5 properties that cost $100,000, finance the other 80%, and she's building cash flow on all 5 of those and actually getting a much higher ROI.
Mm-hmm.
And in that example, what she would be doing was effectively using leverage to increase the ability to invest in multiple assets. And when her cash value stacks up high enough, she could take out the third party lenders, or she could continue to use that strategy of leverage. And that really depends on their own risk tolerance, their own investment strategy. Some folks, they're going to eliminate those third party loans, and they're going to take that cash value and just totally take out the third party debt. And so the only debt that would remain on that particular real estate asset would be their own private bank. Yeah. So the guaranteed financing part means you don't go to the bank and you don't have to qualify. You don't have to go through any type of,
Yeah, because you're the bank. Yeah.
You're the bank.
Yeah.
So you look that guy in the mirror and you make sure that you're making a good loan on a good asset, and you do that. So, but I describe the principle of leverage because a lot of times people get ahead on that concept of leverage, right, as opposed to just buying one property for $100,000. And let's say you're making $2,000 a month, you got 24,000 in gross cash flow versus, if you spread that across 5 properties and you got 24,000 times 5 in cash flow. So, and you're able to just knock those debts out a lot faster. So that's the velocity of money and guaranteed financing working together.
Yeah. And replenish much faster. Okay. All right. Number 6 and 7. What are those on your 7 pillars?
So guaranteed compounding tax-free growth is the part inside your policy that cash value and your premium dollars, they are compounding inside the policy annually, and there's no taxable event. And so I think it was Einstein who said the compounding interest is the 8th wonder of the world, or something along that line. And if you're not getting compounding interest, then you're making a mistake. Mm-hmm. So you don't get compounding interest in your centralized banks. You don't get compounding interest in various other investments or formats, but in these policies you do. So that's something that is very distinguishable, and it also takes out the market risk with your policies and the values in there. You're not subject to market risk. So this is not universal life. This is not indexed universal life or any type of risk transfer to the owner of the policy or to us. You're not taking on market risk. But in those types of policies, universal life or indexed universal life, UIL, you are taking on market risk. And one of the things that's right.
And so this is about being in control of the risk, right? That's sort of the fundamental aspect of it. Yeah.
Absolutely. If you're going to use your cash value and put it to work in investment, you should be the one that's able to identify that risk and not have it subject to equity market risk. So it never goes backwards. You're going to only see a steady prodding forward with this compounding growth. And after a certain number of years, it starts to go more parabolic. And that's really the beauty of this and the magic of it. Some folks, they lock this stuff up for retirement strategy, and some are using it for the leverage.
Yeah. It's interesting. I've seen some financial people describe that risk control paradigm with a pyramid, right? And they'll describe it, in the manner that you want to have more control. So you should start with these sort of strategies first and get that established. And then over time, as you go up the pyramid, you have less control over it, higher risk, potentially higher returns, but that might be where you're doing some of your, trading or investing or self-directed activities. And a lot of people invert that pyramid, right? Say, well, they'll start with that self-directed trading or investing. It's, high risk, low control, and then blow out what capital they have. When instead, turn that the other way around, start with these foundational approaches that you're describing, and then build on top of that. Does that make any sense?
Amen. It absolutely does. Sometimes we'll describe that as, hare and tortoise paradigm. And some people go, well, this isn't, I can make this much here. I can make 12% over here. I can make 15%. Well, no, you really can't over 30 years. Right. And likely there's going to be a risk factor there that may blow you out totally.
Yeah. And the loss of control that.
Absolutely.
Yeah.
I mean, you've got this third party risk. Whenever you've got, a transfer of your money to someone else, that's, you've got that risk, that counterparty risk. Whereas these insurance companies, they don't fail. I mean, they've been paying dividends since before the Civil War, year after year, through the Great Depression, through the Civil War, through every economic upturn and downturn that there is. And it's just one of the reasons why, Grant, is because there's a cash reserve requirement of 1-to-1, as opposed to a cash reserve requirement at a Wells Fargo of maybe 10% or less.
Yeah.
So they take a dollar in deposit and they're able to lend out 10 or perhaps even 50, depending on what their total asset base is. And that's funny math.
That is.
You just print money out of thin air, and then they're able to loan the printed money at an interest rate, and they're making money on something they never even received or created.
Yeah, they received. Fascinating, right? Before I ever heard about this approach or this technique, I have to tell you my origin story of learning about this for the first time. It was my wife was driving our minivan. It was when our kids were little, and she was backing out of the garage, and kids were bouncing around everywhere. And, I would have made the same mistake, but she wasn't watching. And she was turning around talking to the kids. Hey, kids, sit down. She backs out and just whacks the mirror off of the side of the house, right, on the minivan. And so, I come home from work. She's like, the mirror's hanging off the side. So I look at it and go, well, and it was a really old minivan. And I was like, well, okay, let me go get it fixed. And so I took it over to the dealer, and I had this thought go through my mind. And the thought was, wait, rather than, because at the time, I think auto loans were going at like 4% or 5% or something like that. And at the time, our house had been paid off, but I decided to take out a home equity loan to do some fix ups on the home. And it was running, the interest rate at that time was like 0.5% on this home equity loan. And so I'm in there looking at getting the car fixed, and I'm in a dealer. And all of a sudden I go, let me go look at the floor, showroom. And I walk over and, I pull out my home equity checkbook and I just pay for it right there. Boom. And I get this car. Of course, still today, it's a joke. If dad goes to fix the mirror, comes home with the new car. So I come back with this car. And the whole way I'm driving back thinking, I'm a banker, man. I'm a banker. I just floated this thing myself, and got home and of course got, paid that off at a much less interest rate. A few years after that, I heard this principle you were talking about, you've been discussing here, and it clicked. I went, wait, that's kind of what I did, right? But it wasn't using a whole life. But the whole principle is, let's put the people in charge, right? Not some other policy or program that large organizations are bestowing upon you, but rather put us, the people, in the driver's seat, so to speak, and be able to make those decisions themselves. And I think that that's really liberating, if that's a good
Absolutely.
word.
Yeah, that's absolutely right. And that's exactly the same principle. Is you're taking back the banking equation. You're operating a private family bank that has generational value and has, where you are able to touch the same dollars that you make multiple times, like we described in one of our examples, and that velocity really accelerates your wealth curve. And without the taxation issues and without the asset protection risk, you're able to transfer assets generation to generation and take a whole nother opens up a whole nother doorway.
Wow.
And so that brings us to our seventh pillar, which is legacy value and the tax-free transfer of these policies and the death benefits to the next generation. Beneficiaries.
Wow.
Yeah, tax-free.
Yes.
So think about this, for example. There's a guy who most people know named Prince, and the artist formerly known as Prince. He was a pop rock singer, pretty well known. Yeah. And he died not too long ago with an estate value of about $200 million.
Okay.
And he was a resident of Minnesota, ironically. And he had no private banking structure in place. He had really no estate tax planning structures in place. And between the federal government and the state of Minnesota, they took over $100 million of that $200 million and in taxation, in estate taxes. And his beneficiaries and heirs, are left holding the short end of the stick. That none of that would have occurred with proper planning or that same money in a private banking situation. And then I was reading some articles on Susie Orman, who's a supposed financial guru, and she talks about private banking on occasion, and she really has no concept of what it really does. And in this interview article with the guy from New York Times, she says, I'm so worried or concerned about my partner being left with less than half of my estate. And I think at the time of the article, she worth about 65 million. And so her partner, she said, is going to, have to take 30 million or whatever instead of 35. And she didn't know how to overcome that problem. And I thought, this is really unbelievable in the sense that it's such an easy solution. Yep. And we talked about this kind of off recording about it's literally the stroke of a pen that you can accomplish these values and these benefits, the 7 pillars, without having to be a black belt in any particular one realm.
So you don't have to be a financial genius. You just have to know that that's available, that it's there.
Absolutely. Yeah. So you enter the policies, you fund your policies, you keep funding your policies, and you enjoy these benefits. It's really not rocket science. It's more just of learning that it's there, and it blew my mind. It was an epiphany to me, having practiced law for decades, and then seeing this was available. I thought it can't be that easy. It can't be that easy to with the stroke of a pen to protect assets, but it is. I mean, it's codified law, and these contracts, Grant, it's worth mentioning that they are regulated state by state. So each state has their own statutes that govern the law, the protection,
your ability to protect it, right? So some states better than others, or worse, right?
Absolutely. And it's kind of like the post-Civil War era statutes in southern states. They protect their citizens' life insurance policies. They protect their citizens' homesteads many times in comparison to other northern states or western states. And so it is.
Wow, that's huge. Okay, so all right, I've really enjoyed the conversation. If you were to point people to a place to go to learn more about this, Seth, where are you going to point them to?
It's really easy. You go to our website, privatebankingstrategies.com. That's privatebankingstrategies.com. And therein, you're going to find an offer. You can read a book that we wrote that tells you about secrets that banks don't want you to know effectively. And I like to call it a red pill book, and it spots issues that people may or may not be aware of. And it amazes me how many folks don't really understand what the banking folks are doing to them, and with regards to mortgage rates, with regards to all sorts of issues. So this red pill book is something that pops up there for you, and you put your contact information, your name and your email in, and you can listen to the book on audio, or you can take it in a written form. And that's really where we start. On our website, Grant, we've got a pretty wide volume of resources, from podcasts that dive into particular pillars or how the banking operates, to blog articles, and then our emails that will come to you also address certain issues like the Dodd-Frank Act and why does that matter to you?
Why does that matter? Yeah.
Yeah. Wow. Are your is your cash safe in a centralized bank? Why or why not? Are there simple things that you can do to protect yourself? So we try to add value in those emails that come out to folks. We try to help them make a decision that this is, for them or not for them. And it's really that simple. So you just hit the website, privatebankingstrategies.com. You can have the book for free, all the podcasts, all the emails for free. And if those things resonate with you, then you can schedule an exploratory call with Vance and start to get into the nitty gritty of it.
Into what it means. Wow. Absolutely. Seth, thank you so much for taking the time here today with us and with our audience here. Very enlightening. It feels like we're popping out of the Matrix, right? With the red pill there. I love the analogy. Thanks again for joining and for going over this today. Everyone, take a look at what it is that Seth is talking about. privatebankingstrategies.com. Thanks again for joining in, everybody. And until next time, become your own private banker.
Thank you, Grant.
Thank you for joining Grant on Click AI Radio. Don't forget to subscribe and leave feedback. And remember to download your free ebook. Visit clickairadio.com now.